Equity mutual funds are the perfect vehicle for people who want to own equities but don't have the time or inclination to do the homework. By Peter Lynch, legendary manager of Fidelity Magellan Fund. Welcome back to the channel. Let's be honest for a second. Have you ever looked at your bank account and thought, man, my money is just sitting there doing absolute nothing. It's basically on a permanent vacation while I'm working my butt off. So you decide you want to grow it. You open an investing app or a demat account, trading account, and immediately you are hitting with a massive wall of words like alpha, beta, large cap, expense ratio, liquid assets, volatile, small cap. That's some. And you are just sitting there thinking, bro, I just wanted to buy a better phone next year with some extra cash, not pass a Wall Street exam or a BSc NSC exam. Then some guy on Instagram whispers the holy words to you: mutual funds. It sounds safe, right? It sounds adult. It sounds like mature. But what actually it is. Today we are breaking down mutual fund in plain human English. No suits, no confusing charts, and absolutely no finance bro energy. Just pure simple truth. Let's dive in. That will help you to achieve your dreams. I'm giving a disclaimer. I'm not a master of mutual funds. I know 1 to 2% of mutual fund, but I can teach you so you can go and invest your money. And I am not recommending any of these mutual funds. They are really risky. They are of risk. They contain risks. You should do your own research and buy them. Okay, let's start. Okay, you imagine you want to throw a massive food party. You want pizza, burgers, sushi, tacos, and those fancy little desserts with the gold leaf on top. If you try to buy all that by yourself, two things will happen. First, you will entirely broke. Second, you will end up with a way too much food for one person. So what do? You call up 50 or some of your friends and say, let's do a massive potluck. Everyone chip in $20 and we will buy a giant spread of everything. That's, my friend, is a mutual fund. Yes. You and thousands of other regular people pool your money together into one giant pot. That is a mutual fund. That giant pot of money is now massive enough to buy a little bit of everything. A piece of Apple, a slice of Reliance, a tiny chunk of Google, or a bit of HDFC Bank. Instead of buying one expensive stock, your small investment just bought you a microscopic slice of 100 different giant and large cap companies that you alone cannot do. Now, before we go any further, let's address the elephant in the room. Crucial disclaimer. Please listen to it. I am just a guy on YouTube, not your licensed financial advisor. I am not recommending you buy any specific fund, stock, or investment. I am just explaining how the machine works. Please do your own research, use your own brain, and don't come after me if the market has a bad day. Cool. Let's protect our wallets and our friendships. And our channel also. Now, you might be thinking, who chooses the food for this potluck? Because if it's my cousin Suresh, we are just getting 50 bags of chips. Valid point. And that's where the fund manager comes in. Think of the fund manager as a professional party planner. You hire to manage the food. This is a person who literally went to school, studied the art of grocery shopping, and watches the market 24/7. In the real world, they look at the stock market and decide exactly how companies to buy and sell so that the collective pot grows. You don't have to do any research. You don't have to watch the news. You just hand them your money, go sit on your couch, let them do the heavy lifting, and you relax. Just do some research on it before putting the money. Of course, they don't do this for free. They take a tiny little cut called as expense ratio. It's basically their cover charge for managing the party. If a fund has an expense ratio of 1%, it means every $100 they manage for you, they keep $1. Pro tip for you guys: always look for a lower cover charge. We like keeping our dollars, right? So why to give them that much? Why not just buy single stocks? Now, some of you stock market cowboys might say, "Why should I pay a manager? I will do. I will go buy my shares by myself." Sure, you can do it, but let's look at the classic egg rule. If you take all your life savings and put it entirely into a trendy stock, you are carrying all your eggs in one single simple slippery basket. And if that company suddenly makes a terrible mistake, like renaming their company to something weird or getting replaced by AI overnight, your basket drops splat, your money is gone. With a mutual fund, because you own a tiny fraction of 100 different companies, you have 100 different baskets, and that is called diversification of your investments, and that really helps. If three of those companies completely crash and burn, it's fine, because the other 97 companies are doing great, carrying the weight and keeping your money safe, and then also showing you green signals in your PNL. In the finance world, they call this diversification. In human words, it just means don't be an idiot, spread your risk to different stocks basket and different shares of companies. Active versus passive. Okay, we are talking about active investing versus passive investing. Now, when you go to pick a mutual fund, you will run into two main personality types: active funds and passive funds, often called as index funds. And this is true whether you live in Mumbai or New York, NYC. Let's break them down into real examples. Active funds. This is like hiring an aggressive, energetic professional trainer. The fund manager is constantly running around trying to beat the market. In India, you have things like the Parik Flexi Cap Fund or SBI Blue Chip Fund, where human managers are actively picking the best companies. I am not recommending, okay? In the US, think of the famous ones like the Fidelity Contra Fund, if I'm pronouncing wrong, then sorry, or active tech ETFs, where managers place big active bets. Because these people walk around the clock, their the expense ratio is really higher. Passive funds or index funds, these are the chill introvert cousins of your. The manager doesn't try to be a genius, they literally just copy a major market index and say whatever the top biggest companies are doing, we just do that. In India, you will see funds like UTI Nifty 50 index fund or HDFC index Nifty 50. They just mirror the top 50 biggest companies of India. In US, you have giant legends like Vanguard 500 index fund, VFIAX, or the Fidelity 500 index funds, who track the 500 biggest US companies like Apple, Microsoft, Amazon, Nvidia, etc. Because they are just copying a pre-made list. Their fees are incredibly cheap. The showdown: lump sum versus SIP. Alright, now let's talk about how actually you put your money into these things. You got two choices and they are fundamentally different vibes. Lump sum versus SIP. Lump sum is the all-in approach. It's when you get a big chunk of cash, maybe a festival bonus or an inheritance, or you finally sold that old bike, you dump it all into a mutual fund in one single day. It's great if the market is at a low point, because you buy everything on a sale and in a cheap price. But if you dump it all in the right before the market crashes, well, you are going to be staring at a lot of red numbers for a while, feeling very stressed in your PNL. I'm guaranteeing that. SIP or systematic investment plan is the slow and steady approach. Instead of dumping a giant mountain of cash at once, you invest a small fixed amount like 1000 rupees or $50 automatically every single month on payday. The beautiful thing about an SIP is that it removes the emotion. Yes, if the market crashes this month, your 1000 rupees buys more mutual fund units because they are cheap. If the market zooms up next month, your portfolio values goes up. It's called rupee cost averaging or dollar cost averaging. But in human words, it's just mean you don't have to stress about the timing in the market. You just relax. Respectable returns. What can you actually expect? Let's talk numbers. Because if you see an ad promising that a mutual fund will double your money in 6 months, That is not a mutual fund. That is a scam. Run away fast. What are the respectable, realistic historical returns if you hold a fund or for a long time? You say 10 years in India. Equity or index funds, if you look at the historical data of Nifty 50 over the last decade, a solid, respectable long-term return had averaged around 11% to 13% per year. In US, S&P 500 index historically over the long haul, the US stock market has averaged around 9% to 11% per annum when adjusted over decades. Now, 12% might not sound crazy compared to the random crypto coins, but remember compounding, the power of compounding. When you make money, it around 12%, that profit stays in the fund and makes more money next year. Over 10, 15 or 20 years, compounding turns a tiny monthly SIP into an absolute mountain of wealth that can alone manage your whole retirement journey. The bottom line is this: mutual funds aren't magic, they are just a smart, collective way for regular people to let the biggest in business in the world grow their hard earned money over time while they sleep. Again, do your own research, look at the expense ratios, figure out if you're lump sum or SIP person, pick what works for you. If this video made finance feel a little less like a foreign language, hit that like, subscribe to the channel, drop a comment below, let me know. Are you a team of SIP or a team? Are you in the team of SIP or in the team of lump sum? Follow me on Insta, Rudra Invest, and subscribe this channel Chalk and Key for more videos like this. Peace.